I'm pretty excited about this. Awesome. So I'm just going to introduce our panelists here. First of all, we have Ashley Wilson from Bar Down Investments, primarily focused on multifamily investing. Welcome, Ashley.
Thank you so much for having me.
Really good to have you today. We have Bob Fraser from Aspen Funds. How's it going, Bob?
Hey guys.
Hey, welcome, welcome. And we've got Feras Moussa from Disrupt Equity. Welcome, Feras.
Hey, how's it going?
Awesome. We got different parts of the country. I'm in LA. Ashley, I believe, is in Philadelphia area. We got Bob in Kansas City and Ferris in Houston area. So we've kind of got most of them, unless we don't have like Alaska or Hawaii or something. We've got a lot of, a lot of the world covered. So a lot of the US covered anyway. So let's jump into it here. Obviously, things are always changing. There's a lot that's happened with politics, obviously with some of the Trump effects of tariffs, the laws. There's a lot of hot topic things we can get into. But I want to just really talk about just, for each of you, what's the one way you've adapted your investment strategy this year? Obviously, there's been some changes. So if somebody wants to who wants to take that jump in, and we'll kind of go around the room here.
I'm happy to start.
Great.
A lot of things have been changing, obviously, in the multifamily space over the past few years. And I would say that this is a bit of a softening continuation of the tail end of 2024. With respect to what has changed for us, one of the things that I was a huge proponent for was the fact that people were saying that we'd have this oversupply and that we'd see some softening in the rental asking rates because of an oversupply issue. And I said from the beginning that I thought the data was incorrect. People were using permits to forecast the supply that would be coming online, and that just wasn't true. Permits don't equate to finished projects. There were a lot of abandoned projects just because of debt issues. So what ended up happening is we saw a little bit of a stabilization in the rental markets, but it wasn't as soft as people had forecasted. And it also coincided with seasonality and other challenges to the multifamily space with, for example, foreclosures and units being available in the first place of existing products. So with respect to how we changed a lot of things, we actually stayed consistent with what our whole business model was, but we added development because one of the things we noticed is the lack of available deals in the market place. Because we didn't change our underwriting, we didn't change anything. We've stuck to our guns and stayed consistent throughout the different changes in the economic cycles. And what we're seeing is an opportunity in the development side because so many people are fearful of development with factors not being as predictable as normal. For example, with tariffs and interest rates and insurance rates and labor supply. So that's an opportunity that we've added into the arsenal. So we're doing a development project currently, but other than that, with respect to existing multifamily, all of our fundamentals have remained the same.
Yeah, great. Thanks for sharing that. Yeah, definitely things have changed. So times they are a changing. Why don't we go to Bob next, and we'll come over to Ferris.
Yeah, I mean, three things. We're doing less multifamily and more some of the other asset classes to make a little more sense in today's market. The multifamily we are doing is primarily agency assumptions at a very good basis. And we're doing a lot of pref equity, so pref and mezz. So we've gone down the capital stack in less in equity and more in debt and debt-like equity. So we can still play the market, but without taking the risk.
Yeah, love it. Thanks for sharing that. Ferris, what about you? How are you? Have your strategy changed this year investing?
Yeah, I mean, I'd say for us, it's just, again, continue to double down on operations, right, is the first and most important thing. I mean, we're vertically integrated, have the management company. Just there's a lot of good hires out there, and so really trying to get just laser focus on getting the cream of the crop. And then for the acquisition side, it's really a couple of different things, right? First and foremost, I mean, basis is the most important thing right now in terms of, you're starting to see some deals and our two most recent deals that we're picking up, I mean, 20, 30, 40% discounts from where they would have traded 21, 22. And so for us, there's deals that still pencil in that we basically pass on just because, hey, the basis just doesn't make sense. And so we're hyper focused on getting deals at a good basis. We have a deal in San Antonio right now that 2008 construction that we're picking up 132 a door. That same deal would have been the 170s, 180s, and it's a good going in cap rate. And so really hyper focus on just the quality of the asset, because this is the time where we can cycle out the portfolio and pick up deals that are just higher quality assets, right? Go in with the right capital stack up front, get the right equity in place and the debt in place, and ride out the deal over the longer term, right? So.
Right. So that's something I think all of you have now mentioned things that we're doing things a little bit different. Like Ashley was saying, development. Bob, you're saying we're doing other things. We're doing, assumptions. We're going in the debt stack a little different. We're doing even other assets. I know, Feras, you're also doing some private equity stuff like we're doing as well, cash flowing type of things. What do you think what does the timeline look for a multifamily recovery? We've seen, 20 to 40% reductions in value of the same asset over a 2 or 3 year period. And it hasn't really recovered. So where are things headed? Like, what's next?
I'll go ahead and answer that one. I mean, we met with today. I mean, we actually met with the head of kind of the director of Freddie in Central US, and right now there's just a lot of uncertainty. Right, we have a lot of phone calls with lenders, bridge lenders specifically, that are starting to foreclose on deals and, starting to look at some of those deals. And again, they still don't make sense, right? Every one of them have not made sense at the note value, right? The lenders are still kind of trying to stick to their guns and hold at the note value, and they still aren't making sense. And so, I mean, personally, I think in the next 9 months, a lot more distress is going to show up. A lot of things that people just kind of wrote out, and especially here in Texas, we have kind of this whole tax abatement thing that was going on. Now that's kind of clamped shut. And so people that were on the edge are basically having to force to make a tough decision. And so I think we'll start to see more of those kinds of deals. And that's usually kind of 70s, 80s vintage stuff. But at the same time, I mean, I was talking to someone I know who has a 2018 construction deal, right, in Central Texas that essentially had to give it back, right? And so you're seeing it across the market. And this is where the capital stack really matters, right, that you chose. And there's a phrase that I like, which is, the problems you're dealing with today are usually decisions you made 3 years ago. Right. And so it kind of all threads together.
Yeah. Thanks, man. Who's
I'll
next?
jump in there. I mean, so we do quite a bit of Midwest investing, and the Rust Belt and Midwest states look great. There really has not been a big reset. I mean, I think there's fewer transactions, but we're seeing rent growth. We're seeing roughly, 6% rent growth in the Midwest region, and have been seeing that. So it's been pretty good. I think, we're seeing lots of vacancies and, Dallas, Sunbelt, 10, 15% vacancy rates and these places. It's just there's a lot of markets that have been overbuilt, and it's going to take a while for them to flesh out, but there still is some good opportunities. My view is that, and I've been, predicting higher interest rates for longer. I've been doing that for the last 4 years. And higher inflation as well. And I think that's going to continue. I don't see rates coming down anytime soon, and there's a lot of reasons for that. So I think it's going to be a kind of a slog a little bit in the markets. I think there's going to be deals, but we're going to have to work for the deals.
Yeah. It seems like there's more work happening to find deals, or to find the right kind of deals that actually make sense.
And a lot of guys aren't trading, right? There's so just in our pref equity fund, we underwrote about 75 deals in the last 90 days. And it's amazing how many of these guys for acquisition pref equity. It's amazing how of them that they're not getting the discounts. They're not getting the 25% discounts that we would expect to see. They're overpaying for the assets. And we're passing on most of the deals because the buyers are still not demanding lower prices in these assets, and the sellers are able to get them for deals that don't pencil. So I think the market still there's some reality that has to come to the market.
Yeah. And Bob, maybe for listeners, right, what are you guys looking at? So people can understand from a pref perspective, right? What are you looking at for last dollar in?
You mean what we like to see?
Yeah, with your last dollar kind of wording.
For our pref?
Yeah.
Yeah, we go up to 75, sometimes 80.
So 75 to 80% loan to value on that you're coming in.
Yeah.
Yeah. Got it. Okay, great. Ashley, what about you? What are you seeing? Where are we headed from here in the multifamily space?
Yeah, so like Bob, we also do pref equity too. We've done it for several years now because we saw the change in the market. And we shifted our focus a few years back to come in a different point in the capital stack and partner. Um, and that has provided some opportunities. I think there's a combination of the lenders just reacting differently to this recession in this space versus the residential recession. So in 2008, we saw a lot of lenders trying to offload properties to only realize how quickly the residential space rebounded. And if they had held them a little bit longer, they wouldn't have had to take such a loss on the books. And I think lenders this time around are banking on, or at least trying to bank on the fact that they got these properties for pennies on the dollar, and they're hoping by operating them themselves that they'll be able to weather the storm, so to speak, and then make up for some of their losses on some other properties. So we're seeing a lot of lenders come into certain markets and hold a majority of the property. And I think that has been influencing markets, not only asking rents, but also with respect to cap rates. So in terms of what Bob was saying earlier about not getting the pricing and the discount on pricing, I think that's part of it. People are only selling if they, in major MSAs, if they absolutely need to, still in a distressed situation. I also think that there was such a run up in multifamily from 2018 to 2022 that people forgot the fundamentals of multifamily. And the majority of folks that came into this space in multifamily during that period of time came from residential real estate, myself included. Residential real estate is a very quick transactional type of investing strategy. Even if you're doing like Airbnbs, it's an immediate gratification process with cash coming in immediately. Flipping's another way, wholesale. There's so many different asset classes in residential real estate where you can make a quick buck. And because of the compression in cap rates and the lowering of interest rates during that period of time of 2018 to 2022, I think people's appetite for holding these projects and understanding how to really operate long term and being in it for a marathon versus a sprint was lost. So I think the future of multifamily is that we're really going to see the cream of the crop right now. So we're going to see the good operators, because the good operators are going to shine through this period of time. We're going to see the good construction companies because they're going to be able to weather the storm of having clients that didn't pay them and they had their property foreclosed on. We're going to be able to see all of these people that you want to do business with moving forward, because they're the folks that remembered the fundamentals of the operations, the investment strategy, and really how to underwrite and not get greedy, right? Because the whole saying of, pigs get slaughtered kind of thing is, I think, rearing its ugly head right now.
Yeah, it's amazing. I think there's two things really that make the difference in a market like this. One is the debt that you have. What kind of debt do you have on a deal? And secondly, it's operations. So if you struggle, especially on operations, like you said, good operators really shine when times are not good and really sets them apart. What's one tactic that each of you are using to grow NOI or your net operating income right now? Feel free to jump in.
Well, I can take this. I
Sure,
mean,
great.
this is honestly what I'm known for. So operations is something that I focus on every single detail and aspect of operating multifamily. And I really think that if you did your homework, like Feras said earlier, the problems of today are decisions you made 3 years ago. Well, the lack of problems you have today are decisions you also made 3 years ago. So I've had folks ask like, oh, you must be really struggling right now. Things must be really hard. And we set things up really, really tight from the beginning. So we didn't focus on having things carry us through like compression of cap rates and debt. So by doing that and focusing on the operations, then when things come along and they're more challenging and unexpected, like for example, 10 to 15, 20% hikes in insurance, you can just allocate all of your resources to figure out alternative strategies, as opposed to being spread so thin because you never focused on operations from the start. So one of the things that, we focus on is making sure not only that we focus on our occupancy and having this stable occupancy and consistency within occupancy, but also on collections. So we have tighter criteria to get into our properties than the markets. We actually test and analyze the entire market's criteria for coming into the property to limit the amount of people that we have to chase later on in terms of collections. So that's one way in which we really focus on making sure that we're not spending all this money to get people in the door to only have them not pay their rent, skip on the property, leave without paying their final bill, and costing us more in the long run. So it's all those little details I think can really translate into massive gains.
Reminds me of John Wooden when he was coaching. The first thing he would do with his athletes is he would say, "I'm going to teach you how to put on your socks." These guys that are, world-class athletes, just teaching the basics, right? So a lot of times, the more, complex you get, it's just coming back to the basics of something like operations and just really making sure you're getting it done. Bob, what do you think? How are you improving NOI, or what are you doing to kind of maximize that right now?
We're a lot of guys are having trouble with NOI right now with taxes and insurance and you name it, vacancies and turns. And honestly, it's just the best time to buy. So I would say, improve your NOI by buying discounted properties, but
Yeah.
we do a lot of, tend to focus on, it seems, on marketing, just getting really good managers who know how to attract tenants and making the properties look good. So it's less on just the cost side and more on the revenue side. So where we've been having the most luck.
Yeah, it's great.
Mm.
Ferris, what do you think? How are you guys
Yeah,
improving it?
I want to actually, Bob kind of said it loosely, but actually I want to double click on that. It's really getting the right people, right? It's what I alluded earlier. Right now, there's a lot of good talent out there, and it's like I like to say, one of the best hires we had was hiring a full-time in-house recruiter, right? Whose job is purely on placement, and there's just some really good talent out there. And it's funny how you can have a property where it hugs 93% for 2-3 years, and you get the right manager in there, they close the gap, get it to 97%. That 4% is your profit, right? And so really getting more methodical as a company that, hey, the expectation is not 93, 94% occupancy, it's really getting to 97. And what do we have to do to get there and hold it and set that expectation with the right staff? And, we've just seen across the board that shift in terms of occupancy and really getting to that level. So that's maybe, my little secret, just getting even better people than we had before. So.
Yeah, and that's staffing is always a challenge. So let's talk for a minute about AI. Let's talk about prop tech, property technology. Let's talk about some of the changes that are happening in the industry. I know now, just from a simple level of sometimes, maybe you don't always have to have somebody show the unit. Somebody can call and make an appointment or do it online. They can put a code in the unit themselves, walk the unit. A lot of times maybe you don't want to do that because you want to actually have a salesperson there to walk them through it. Just talk a little bit about how technology, either from AI, virtual assistants, what tech or tool is kind of helping you in that space today from a management standpoint? What's the start? Okay.
Man, I'll go ahead and say this. I mean, my background software, right? Formerly worked at Microsoft, and yeah, there's a lot of cool stuff coming out with AI. It's still too premature for, at the size and scale of the operations that most people on this call are talking about, right? I mean, a lot of these companies, again, 2 years ago, nobody even knew what, ChatGPT was, right? And so imagine the time it takes for, verticals to get built and flushed out. And, we've been approached by a lot of these companies, and there's some cool stuff coming. But it just, in my mind right now, none of that stuff is really production grade ready where it's a no-brainer to roll out across the portfolio. And so maybe I'm taking the contrarian position, but there's a lot of cool stuff in the works. But again, right now it's still very vanilla. Like, yes, there's efficiencies that are being done, but all that was stuff that we did pre-ChatGPT also, right? And so
Yeah.
it'll be interesting to see kind of where things go. But as of right now, people still need that level of touch. Still, you need that salesmanship, and use that leasing person to do more than just sell lease.
So no Optimus robots, humanoid robots fixing your toilet or knocking on
Not
doors.
yet.
It's not, we're not there
Working
yet.
on that one
Down
though.
the road. So yeah, who's next? Ashley, Bob.
For us, what I would say, I would piggyback off of what Ferris just said with respect to customer service. We actually did try to implement a lot of different automations. And what we found after doing some data analysis is that the conversion wasn't as great. The conversion is still so much better with respect to personal relationships and personal touch. Those touch points of your leasing agent or virtual assistant, we have virtual assistants across our properties as well. That provides just a better relationship experience. So I think it's not about whether or not you're ready for AI, it's whether or not all parties that are going to be interacting with this technology are ready. And just in the space in which we operate, it doesn't seem like the clientele that we're seeking across our properties want that aspect of their experience to be replaced with automation. Now, internally, where the way we operate, we have a lot of tech integration throughout internal communications and metrics and analysis and running operations and crafting marketing and marketing analysis and all these other aspects. We're utilizing it internally, but to replace the customer service experience aspect of it with virtual touring and putting in codes and having automations go to a certain point, but at that, there seems to be not a full embracing of the technology yet, at least in the space in which we operate. So we actually released it and then we clawed it back in because our conversion rates were so much higher when we had humans interacting with our prospective tenants and residents.
Yeah. Obviously you get higher returns when you're, interacting with a real person. Eventually, maybe AI will get there. It's not there yet, but it may get there. Bob, what about you? Any tools or prop tech or things that you're seeing that have been helpful to move the needle for you guys?
We haven't seen anything along those lines. It's interesting.
Yeah, I know there's all kinds of technology and things coming out saying, oh, it's going to change your life, and things do, but it's, obviously takes time for adoption for that. Let's talk for a minute about, we're going to get into, I want to talk about other assets. I want to talk about some real estate mindset things, but let's talk for a minute about some of the tax advantages we had from the 2017 Trump tax benefits for multifamily. Obviously, that really has slowed down because where we were at 100% depreciation, so people were getting typically 80 to 90%. Often, in a lot of cases, for the amount invested in year one, they were able to take all that on the front end. Now it's at 40%, so they might be getting maybe 20, 30% of the amount invested. So I know there's some talk about this. Anybody been following the legislation if that's planning to come back? I think I've heard some chatterings about that, but is anybody up to date on that? Have any opinions on whether some of those tax breaks for accelerated depreciation will come back?
I think expectations, bonus depreciation is definitely high on the list of things to come back. So I think for most people on this call, that's probably the biggest impact, right? And just getting, being able to depreciate a lot more on your real estate investments. So
yeah, opportunity zones is back on the table, and upping it even more.
Yeah, so they're going to talk about extending those, and I think it's good to keep abreast of those. Let's talk for a minute about I guess this is, I think there's so many connection to being a real estate investor, being an investor, and mindset. What's one belief that you've had, or common real estate belief that you strongly disagree with? And it can be anything. It can be something around mindset. It can be something about people invest this way, or everybody thinks this, but it's just totally wrong.
I think the saying that, now is not a good time to buy, it's never not a good time to buy. I don't believe in that. I don't believe in it fundamentally, because if you believe in that fundamentally, you believe in the fact that the opposite is true, which means that there's no good opportunity out there by default. That means that no one's in a distressed situation across the entire country, across any asset class, across any market cycle. I just don't believe in that. So I believe that it's always a good time to buy. It's a matter of just figuring out what works for you, because I operate differently than Bob does, than Feras does. It doesn't, and we could look at the same property and all have a different way of analyzing it and determining whether or not it's a good acquisition for us to have in our portfolio. But to me, it's always a good time to buy. So that's something that I hear repeatedly, and I normally hear it from people who are probably less knowledgeable in a particular space. But I find that when I talk amongst people who are very knowledgeable about their specific asset class, they tend to agree with that sentiment.
Yeah, there's always opportunities in every market. And if you're not aware of that or open to that idea, you're just not going to see the opportunities or not look for them. So I think that's good. Okay, Bob, what about you? I know you just wrote a book about investing like a billionaire. Why don't you talk about some of the things that are myths people believe that just are not true?
Yeah, well, and the book is all about how the big boys invest, and they make higher returns and take less risks. And they do that through private alts, of which real estate and multifamily is an important asset class. But yeah, I mean, one of the things people don't realize is, for example, compounding. Everybody knows compounding is a way to get rich, right? And a way to create real wealth. But the problem with compounding is it doesn't work if there's volatility. And so people don't realize that. And they think, and that's of course the magic and kind of the magic secret sauce of private alts is that they're not as volatile. They actually have higher returns and less volatility. And if once you diversify across these asset classes, you you get true diversification. And there's another one, by the way. You think you buy 10 stocks in the stock market, you're diversified. You're not diversified because everything in the stock market moves together. And especially since the great financial crisis, everything is correlated to flipping everything. And you can't get diversification. And diversification or uncorrelation is the thing you need, not just diversification. You need things that don't move together, things that zig when everything zags, right? That's what you need. And if you buy the S&P 500 right now, for instance, 30, a third of that index is 10 companies, a third. So you're buying 10 companies. You think you're diversifying, and it's all correlated. So really, you have to. Smart investors, the big boys know this. They have to get into private alts. So
Yeah. And just for people to clarify, private alternative assets such as real estate syndications, other assets, private
yeah,
equity, all the different things.
private credit, private equity, yeah, hedge funds, natural resources.
Yeah. I've read the first couple chapters of your book. I'm excited to read the rest, man. Really excited for your book to come out, and it's a big deal. Looking forward to that. Awesome. And then Ferris, what about you? What's a common belief that about real estate that you strongly disagree with or about investing?
I think it's really maybe a combination of what Bob and Ashley said, which, I tell my investors, ultimately we're there to try to find the best deal available in the market at that time and then work into a structure that makes sense, right? From a risk perspective. And so again, there's always good times to buy. It's about the right deal, right location, and what's the background to it. And so it's easy for people to look back in hindsight and say, well, prices were elevated back then, but also if you put a 15-year note on the deal and you're writing it for 15 years, is the 10-20% elevated price versus where it is today that big of a difference? Probably not, right? And then the other side too is just, I look at real estate, it's more for wealth preservation than it is for cash flow,
Yeah.
right? And we kind of really had that, like as a company, that's really kind of one of the pillars, right? So first and foremost, it's about return of capital, then it's about return on capital. And then how do we start to give investors, the opportunity to cash flow, right? More than that. And so that's kind of where we've gotten more into alternatives. We are operators at heart. We've operated many companies, so companies that started from zero, companies we've bought into, all the above. And so how do we start to really scale that into cash flowing opportunities for our investors? And, we've been kind of building that up, and that's just gone very well for them. So.
Yeah, I think for a lot of investors, I think honestly right now it's a challenging time for real estate. And especially if you want cash flow, a lot of people usually come to our group for three reasons: cash flow, appreciation, or tax benefits. And right now, real estate's really hard to find cash flow. So it is a long-term wealth preservation and growth strategy. But for the cash flow side, we shifted to kind of go into other things. We're going into buying private businesses. We're doing debt funds. We're doing oil and gas, other sorts of strategies that provide cash flow and things. So let's talk for a minute about that. Just on a personal level or in your business, what other assets outside of multifamily real estate or real estate in general do you find they're interesting to you right now? Let's start with Ashley.
Well, from a passive perspective, I don't know if Bob would consider me diversified, but I consider myself diversified because I do think they're in I forget the term you used, but they are not correlated, the opposite of correlated. So we're in a lot of different assets, everything from tech to alcohol company to
And if it doesn't work, you consume the product, right? You know, if it doesn't,
consume the product. I mean,
just
I have it actually right here. So
if it gets really bad.
in case this panel doesn't go well, I can drink
Yeah, yeah, it's 5 o'clock.
RSOA.
It's past 5 o'clock.
But I also I started a company last year called Conference Connect, and that is in tech marketplace startup. So it's bringing together event organizers, attendees, and speakers onto a single platform. And the premise of starting this is looking at other industries with respect to the wave, right? Timing of the wave. I actually have listened to Bob speak a lot on this about timing the wave for different asset classes on other panels that I've been on with Bob and just hearing Bob speak in other places. But that's something that we saw an opportunity. We had an idea and then launched it, and that's going honestly quite well. But that's something that we can look into and leverage what's going on in that space, in that market. So that's something we're actively pursuing. And then we also have these other passive investments that we're throwing some money at. We're obviously in all the normal things that everyone, I think, probably on this panel is in with respect to whole life and other real estate asset classes and precious metals and oil and gas. I mean, we're kind of a little bit in everything. So yeah, we're just trying to stay diversified a little bit across multiple areas, but then where we see huge opportunity, that's where we want to be more actively involved.
Love it. And I know your husband as well is also very involved in economics and real estate, even as a co-host of the Drunk Real Estate podcast. Is that right?
Yes.
That's
Yes.
awesome. So
That's his brainchild. He wanted to start that years ago. And I think he finally got two people drunk enough to agree to it because AJ Osborne doesn't drink, but it is very colorful, especially the further you listen into the show, because that's the more alcohol they've consumed.
The more colorful it gets, the more fun it gets. That's true. That's great. Thanks for sharing that. Bob, what about you? You guys are doing all kinds of things. You've got a mind looking at all different things. What do you find interesting right now, mid 2025?
Yeah, I mean, I'll say my best investment ever made last year was our oil and gas fund, and I personally backed up the truck, made the largest allocation, and it's got the best returns and the best outlook of anything I've ever seen. So I'm super excited about that. We're doing more of those. And very excited about private credit. I mean, being able to get cash flow in a market like this. There's, to Ashley's point, there's always a good time to buy and invest. It doesn't matter if an area doesn't work. There's always some area that is working, and that's so rather than look at the one table that's got of your banquet that's empty, look at the tables all behind you that are full and figure out that, hey, there's always something that's good, right? And so I'm very excited about private credit, and very excited about industrial real estate. We're seeing tons of opportunity, and shovels are busy in doing industrial right now, and a huge opportunity with the tariffs and everything else.
That's where I love when you are a investor, not just being, I'm a real estate investor, I'm a multifamily real estate investor. I'm an investor, right? You're trying to solve a problem. So when I talk to people, it's like, well, what problem are you trying to solve? Do you want cash flow? Do you want long-term growth? Do you want tax benefits? And then finding something that does that, because there's always opportunities, kind of your point, both your points. It's just there's opportunities in every market, both in real estate and outside of real estate. And there's some asset classes that look phenomenally well, from an undervalued or just really, high outlook growth opportunities. So, yeah. Feras, what about you? What are you seeing in today's market? What do you find interesting professionally, personally?
Yeah, I mean, on the real estate side, there's definitely some interesting things happening, right? Again, we're having a lot more conversations with lenders. We'll see what transacts there. But to me, the thing that's maybe I'm most excited about is just on the M&A front, right? Again, there's kind of this transfer of wealth that's happening between essentially that baby boomer generation who historically have been heavy into owning businesses and being able to pick up these businesses at a discount, and they're just high cash flowing businesses, right? And for those listeners that don't even understand what I'm talking about, right? If you buy a business for a 4x multiple, right, which is kind of, let's just say that's status quo. If you convert that to real estate speak, that's a 25 cap market, right? So real estate, we're buying 5, 6, 7, 8 caps. On the M&A side, it's 25 caps. And so you have to be able to operate those businesses. And that's kind of where we've really reorganized our company to where what I call is kind of the backbone, right? That provides services into any of the portfolio companies. But, those are opportunities that we see with really, really high cash flows, really good upside, and the ability to really do forced depreciation on them. And so we're, continuing to scale out into those. And that's just kind of the cash flow opportunity for our investors. And it's just gone very well. So.
Yeah, that's a great opportunity. That's something we've doubled down on as well, where we've been looking at particularly e-commerce and other types of businesses that we can buy 3-4 times profit, and just ridiculous if you convert them cap rates as far as returns. But and then also oil and gas is very interesting. And then also just personally, I've invested quite a bit in precious metals several years ago, and that's been a great thing, not necessarily for cash flow, but just for value and for storing value. So I think that's there's going to be more and more currency creation as we grow. So obviously having debt is a great inflation hedge, just because assets tend to appreciate over time. We know that's going to continue to happen. So so I guess any other we'll get into some questions here in a minute, but any other things that you're finding interesting that anything get sparked as well on a personal level, like, hey, I'm interested, I'm looking in this, or I'm doing this other investment as well, because I know some of you shared maybe one or two things, but is there anything else you want to add to that?
I'll jump in.
Yeah.
I think something that people don't think a lot about right now, and I think they need to be thinking about it, especially real estate investors. Real estate superpower is inflation. Real estate eats inflation for lunch, and real estate is the way to get rich in inflation. I mean, a typical multifamily deal, without inflation, I just modeled a very simple multifamily deal. It has a 2, multiple on investment capital and a 10-year MOIC, right? A two multiple. With a 3% inflation, it goes to a 4 multiple. A 4 multiple. It's insane. And that's just a very simple example. So the key is, everything in real estate sucks right now because interest rates suck. And you know what? Get over it. Interest rates are going to continue sucking. Okay. But play the long game. Play the long game. Buy real estate now at a heavy discount and figure out how to fight, tread water or swim upstream against the debt load, right? And improve those properties. And in 10 years, you're gonna make a lot of money. And that's even after inflation. It eats inflation alive. And even adjusting for inflation, your MOIC is higher. You double your MOIC, just from inflation. So people don't realize how powerful it is. And we need to play the long game in real estate investing, and so I think rates are going to continue to stay high. And I've been calling this, Bronson, you've been listening to me for a few years. I've been saying this for at least 4 years now, and we're going to continue to see high rates. And I still think we're going to see higher rates than people want. That if something normalizing it's just not going to happen. That doesn't mean real estate is going to suck forever. It's going to suck for a few years, but ultimately the supply overhang is going to be burned through, and there's still a lot of demand, and you just need to play the long game. So I don't think investors play the long game enough, and they don't play inflation smart enough.
Yeah. And maybe Bob, there's a phrase that I like, that I heard from a father and son that had been, doing real estate for 40 years. And his phrase is really, those that are rich sell, those that are wealthy hold. Right. And
Yeah.
it's all about the long-term hold, right? And that's the difference between being rich and wealthy. Wealthy, you can hold it and really ride it out over just kind of the compounding effect over the long run.
I like to, there's a lot of people that think that if interest rates are high, then it doesn't mean values can't go up, right? Until rates come down. But if you look at like the 70s and 80s, their rates were high, I mean, very high at some point, and then the values continue to go up. I mean, it just continue to rise over time because of demand and inflation and other
That's right.
factors. Yeah.
Well, the
Ashley.
other aspect, yeah, if I could just piggyback onto that for a second, is the other aspect of it is that we have a high interest rate. Multifamily has always been a hedge against inflation. So I couldn't agree with Bob more, but I have always had the belief that cap rates have such a lag effect. So by the time that we realize the opportunity when cap rates get compressed again, it's too late. So with residential real estate, and there's a lot of factors that go into it. One is with respect to the interest rate versus the cap rate relationship, but also it has to do with the lag effect in terms of when a property goes under contract versus when it actually closes. So the reflection of that price is not at that time of transaction, but actually 90 days in the rear and even longer than that right now. So pre-COVID, the average closing period in commercial real estate was 60 to 75 days nationwide. It's now 90 to 120 days because of a lot of reasons, equity, debt, distress issues, you name it. But the point is, it's a reflection of 3 months prior, 4 months prior. So timing of the market is harder to do in commercial. So to Bob's point and to Feras, I know Feras has mentioned this as well, that if you're thinking you're going to time the market just right, you probably are going to be late to the game. So I think you just, to what has been mentioned multiple times tonight, it's about making sure the deal works for you and not necessarily how do I get the best deal today, because if you're patient and you play the long game, you do fundamentally, if you believe in the long-term hold of real estate and you believe that you're buying at a 20-25% discount, it should rebound quite nicely for you.
Yeah, that's awesome. We're going to start taking some questions now. And we have one question here from Samantha. If you have a question, you can put it in the Q&A box in the center of your screen there, or you can put it in the chat. We'll get to it. So question is, what cap rate and yield on equity are you aiming for now? We'd like to take that first here. What cap rate? Yeah.
I know. I mean, right now you're seeing most stuff. Again, it's all vintage based, but I mean, there's nothing. I don't want to say nothing. There's very few deals that are trading less than a 5.5 cap in most of the Texas markets. Whereas, 2 years ago, most of them were in that 5 to 5.5 cap range. And so right now, what we're seeing on newer vintage stuff is about 5.5 cap. B product is kind of close, 6.25. And your C stuff is really the laggard, right? You're not really seeing as much demand there. And, we picked up a deal north of a 7 cap in place. So.
Great. What else? Who else? I know you guys are in different markets doing things.
It varies for us by market. That's
Yeah.
honestly like a pretty difficult question to answer, because not only does it vary by market, it varies by major MSA versus secondary market and vintage. So for us, we're seeing a wider range than what Feras just mentioned, but he might be more targeted in terms of specific markets and specific vintage. So that might explain the narrower spread. But 2 years ago, we were even seeing sub 4 in some of the markets we were going after. So, to see it now in those same markets, you're seeing higher 5s, 5.75 to a 6 plus. But it really varies for us in terms of what market we're going after and what vintage.
Yeah.
I mean,
Great.
we're looking for kind of screaming hot deals. So, I mean, we're just getting ready to buy one at a 7.5 yield on cost. And
Yeah. You got to find the right opportunity. Okay, we got a question here. Ashley, what type of developments, more specifically, are you liking as investments? This is multifamily development.
It's a multifamily development. So it's market rate. It's in the DFW market. So a market that we've been looking at for quite some time. We like markets that are in close proximity to major downtown markets, but more in the path of progress. So a few different other variables we're using to narrow our focus. But in this particular opportunity, that's something that we've pinpointed.
Yeah, that's great. I see a question here about a Long Beach California market, 3 and 4 unit. I don't know if anybody works in that specific market. So I think you have to kind of, that's a very specific question. Maybe we can take that offline or talk about that another time. Anyone have any other general questions about multifamily investing, about what you should do? Obviously, no specific advice, but hey, I've got, here's how I'm positioned, here's what I'm doing. Kind of what the theme that I'm hearing from a lot of, folks about real estate is, hey, this is a great long-term great long-term strategy. If you structure it correctly, if you find a good deal and you're willing to have a 5-10 year time horizon, this can be phenomenal, right? But a lot of people don't. They want to have a very quick turnaround, or that's not structured correctly, other things like that as well. Another question that's coming here: as a passive investor, what should I look for in a multifamily? Is it a fund or a syndication? Should be worth it in this market, or alternatives such as self-storage, retirement homes, things like that. So I guess the first question is, what should I look for in a multifamily, deal for it to be worth it?
I'll go ahead and take this one. It's funny. So, we've done funds, we've done single purpose acquisitions as well. And what we've seen is investors like to pick the deal they want to invest in. So if we have a fund that has 3 deals, well, maybe they don't like an Austin deal or they don't like a San Antonio. So they want to say, I want to invest in that deal versus the fund. But with where the market is right now, what we're seeing is actually whenever we did do the funds, those deals are able to help prop each other up, right? You have the deal in the strong market that's going well. That deal can help carry the other deals or vice versa. And so you actually get the flexibility with a fund, right? And so you do kind of get natural, essentially diversification, right? They are not correlated. I mean, they're correlated since they're all real estate, but markets are very different, right? What's going on in Austin is very different than what's happening in Atlanta, which is very different than what's happening in Houston, right? We see that in all the different deals. And so my answer to that question is really, there's not a right or wrong, right? There's pros and cons to each strategy, and it's really assessing what your risk tolerance is. A fund can reduce risk. You get less of the big pop because, not every deal is going to be a home run. So if you happen to invest in that home run deal on a single purpose situation, well, then great, you get all that upside. If it's in a fund, it's going to get diluted across 2 other deals as well, or 3 other, however many deals there are. And so again, there's pros and cons to those. And I think the flip side too, the other half of the question, again, it's about diversification. And again, there's not, nobody here has a crystal ball. There's not one asset class is the only asset class that you should invest in, right? If we did have a crystal ball, we would all be doing that one asset class. It's really about getting into a variety of asset classes that matches what you're looking for from a return profile and risk tolerance. And, whether that be storage or oil and gas or, betting into multifamily. I mean, there's not a right or wrong answer to that.
Yeah, I
Yeah.
think what you said earlier, Bronson, when you were talking about the reasons why people invest. So I always say there's 3 buckets why people invest, and then there's a spectrum within each bucket. So you're either investing for wealth preservation or capital preservation, cash flow, or some tax benefits, combination of the 3, right? And if you had to rank them, how would you rank them? And that will help guide you as to where you should start looking, because as Feras just mentioned, every single asset class has different pros and cons. And then whether or not, it's a fund versus a SP, single purpose entity, where it's focusing on one specific asset, then that, to each their own. But in terms of actually vetting, I think a lot of people make the mistake where they're vetting the deal profile and the returns prior to the other 2 things that are way more important. And those 2 things are the team, number 1, and number 2 is the market in which it operates. Because regardless of what the return metrics are projecting, it doesn't matter if there isn't a strong market and a strong team to operate. One of the fundamentals that we use when we're vetting a market is economic diversification, especially when we're in a position where you could either argue we're in a recession or about to be in a recession. When you have lack of diversity for economic contributors to a market, you have more susceptibility to a downturn in the market. So, for example, we don't invest in any markets where tourism is a top 3 contributor to the overall economy within that market in this market cycle, because there's too much exposure for a downturn throughout that entire market's economy.
Yeah, that's good. Another question that's coming up here, and we'll take maybe 1 or 2 more questions, and we'll get into kind of wrapping here, is our DST. I believe they're talking about a deferred sales trust. a wise investment upon selling now. I don't know if anybody has experience with DSTs. They're kind of a mixed bag, but anybody want to talk about DSTs?
Deferred sales trust or Delaware statutory
Yeah, that's the
trust?
problem with DST
Yeah, I
is
know
both of
it's
those.
too. I'm assuming it's a deferred sales trust, but upon selling, but maybe you can touch on, yeah, maybe somebody can clarify. Okay, Delaware. I was totally wrong. Delaware statutory trust. Who has some experience with that?
Yeah, we've done a few of those.
You talk about what it is real quick, just so people can understand. They
It's
don't.
simply a mechanism for trading 1031, doing 1031 exchanges. And you typically buy a piece of an institutional grade property and you don't have to own the whole thing. So, and you can size it to your size. So they're very nice. But you pay a lot for that tax benefit. You pay a
Okay.
ton because once you put a property into Delaware statutory trust, you cannot raise capital for it. You can't change any lease term. You can't change any debt term. You can't raise any capital. So all that has to be reserved for, and it ends up being a pretty low return deals that are highly de-risked. And there it's I argue that you should probably evaluate just paying the taxes, paying your long-term cap gains, and getting better investments. But uh, so I think they're all right. Some investors would rather pay less taxes, regardless if their overall return is still lower.
Yeah. Yeah. No, they can be a lot of fees. Anybody other comments on that? I think that kind of covers it. Awesome. Well, let's get into how people can connect. I thought this was a great panel. Thank you guys. I know it's funny. You can tell too. I think just one comment about this. When we have 200 people at an event like this, I think we've got 50 people or something that showed up today. But, it's when you have just people at all the meetups locally we run, it's just like real estate is kind of on fire. It's actually the most risky time to invest. But at the time like this, where it's kind of like real estate's gone from this, especially multifamily, a really in favor asset to a bit out of favor, right? And so I think it's a time to be able to load up if you're a savvy investor and you need capital preservation and growth more than cash flow. It's a great opportunity. Why don't you just go around each person, just share how people can follow you. You guys are writing books. You have amazing events, all types of things that you're doing. Just really an all-star crowd here today. So just give people an idea how people can follow up with you and connect with what you're doing. So let's start with Ashley.
You can find me on Instagram at Bad Ash Investor, and from there you can link to everything that I just talked about today. That's
Bad
it.
Ash, love it. That's a Bad Ash name, love it.
Mhm.
All right, Bob, what about you?
If you're interested in the book, thebillionairebook.org, and Aspen Funds, if you'd like to get our economic updates and some of our deal flow.
Awesome, thank you. All right, and Feras.
Yeah, disruptequity.com, or you can email me, Feras@disruptequity.com, or you can find me on LinkedIn.
Awesome, great. And then for us, obviously, we'll send you the replay of this event here. If you do want to reach out, we're happy to connect with anybody, just like everybody is here. I do have an event coming up we run called the Wealth Forum, which is for high net worth passive investors. We're trying to kind of put something in the chat. I don't know if I'm able to find it in time. But we have it. It's June 13th and 14th in Orange County, California. We have some amazing people flying in, guests that are going to be here. It's going to be awesome. But we'd love to share with you about that. If you want to reach out, feel free to reach out. I'll put my info in the chat. If anyone wants to put their info in the chat, feel free to drop it in there, guys. And I just really appreciate everybody taking the time to be here. We have these panels because when we get together and we talk about things, it actually makes us all better, right? And I think one thing that's hard to find, a lot of people, we all have our own educational thoughts and channels and things like that. But to get everybody together and have kind of a meeting of the minds or a mastermind together, it really makes us all better. So I hope you like this. Hope you enjoyed it. Thank you, everybody, for being here. If you guys enjoy this, can you guys give them some love in the chat there? Go ahead and give them a thumbs up, just a heart, something like that. Just tell them, hey, thanks for being here, putting this together. They took their time out, a lot of them late in the day to be able to do this, missing dinner. So thank you for being here. Appreciate you guys. Again, this replay will be out. We'll have another event next month. And let me just give you the date on that so you have that. So again, we do these monthly. So that one will be June 17th. The Wealth Mindset for Success. It's going to be the same time. It's going to be a Tuesday at 4 p.m. Pacific. And we've got some amazing guests. Christina Suter, Stephen Pesavento, Tom Burns, and Maurice Philogene. So it's going to be an awesome time. So appreciate everybody. Thank you for being here. We'll send this out. We're done. Everybody have a wonderful evening. Thank you, guys.
Thank you.
Thanks, everybody.